We're joined now by Jason Schenker, president of Prestige Economics. Jason, thanks a lot for joining us. You've heard the numbers. On balance, they are either in line or weaker than economists were expecting, and the S&P 500 futures contract is rising on this news. What's your take?
Well, we see just a really modest month-on-month increase, both in the total and the core by 1/10. Those are really much smaller than had been expected by the street. That's why I think you are seeing some of those futures bounce up here. But it doesn't change the outlook for the Fed this month in its Fed decision. Before this announcement, there was almost 100% chance, it was 99.8% chance the Fed would stay put this month. That's our expectation. The Fed is not going to cut rates this month. We also believe in July the Fed's unlikely to cut rates. We believe that this doesn't change that expectation as well. Again, the CME Fed Watch tool expecting only a 12.5% chance of a rate cut in July. The market expectations are reflecting the next time the Fed's likely to cut rates isn't until September. This report is still in line with that potential for the Fed to cut rates in the future, but it's not likely to be imminent at either of the next two Fed meetings.
Jason, so does this alter? It looks like it's pretty spot on. I mean, little better, which is great, but does it maybe give the Fed, I mean, in the market right now, they're thinking it's going to be 25 basis points for the year, right? Does this give them a little more air cover to maybe do two, maybe to go 50 in your opinion?
It is possible. I mean, the Fed's most recent forecast that we have reflect expectations that the Fed themselves, the Federal Open Market Committee, expected only 2 rate cuts this year. We are going to get those next set of Fed expectations next week. What are their projections for this year? They very likely are going to reflect still 2 rate cuts this year. That would be no change from their prior set of forecasts. And as you might recall from Fed Chair Powell's last press conference following the May Fed decision, he said the word wait something like 23 times and the phrase wait and see, I believe 11 times during that relatively short press conference, which should tell us everything we need to know about the Fed, which is that they are in a wait and see mode because they don't yet know what impact tariffs are going to have on inflation and on growth. Because while tariffs can be, usually are inflationary, tariff fears can be recessionary and deflationary. And what we see from the jobs report is the labor market still looks pretty solid. We saw that last week across a number of different indicators, including the JOLTS openings data showed 7.4 million open jobs in April. Payrolls are positive in May, but a low still 4.2% unemployment rate. All of that's very positive. So the labor market hasn't crumbled and inflation hasn't skyrocketed. And so the Fed might continue to wait and see a little bit longer.
One headline moving on my Bloomberg terminal is that traders are boosting Fed bets, nearly pricing in 2 cuts for this year. So in the market for Fed fund futures, the probability being expressed of 2 cuts this year has increased on this news. How long will it take, Jason, before we get a greater sense of the impact? You've talked about it, the impact of tariffs on inflation. You've talked really well about how there can be either inflationary or recessionary influences. When will that become clearer to investors? What kind of effect tariffs are having on U.S. inflation?
Well, I think that's the big question the Fed is grappling with. And as we've often heard Fed Chair Powell say, the Fed is not on a predetermined course and they are data dependent. And so when is it going to be clear? Well, we're not quite sure yet, right? Because in Q1, we had that modest contraction in GDP, but it was a contraction because imports surged as companies were trying to front run the announcement of tariffs on April 2nd. Well, if imports fall sharply in Q2, which seems likely, GDP could be really positive. And we see that in the Atlanta Fed GDP Now expectations, which have vacillated around 3.5% to 4% recently. So we've seen expectations of potentially really strong Q2. Again, that might be swings in imports. So when would we know? Are things really bad or really okay? Or is inflation really hot or really not? It's still going to be a few more months. We might not really have a good read on what's going on until sometime in Q3, as we see the volatility of the trade, which has been impacting GDP reads, and the questions around how much inflation will feed through to consumers get answered really might not be until Q3. And as we can see in the CME Fed Watch tool, even before today's announcement, the most likely next Fed rate cut is likely to be in September.
So Jason, basically what you're saying is that this is looking like it might be Goldilocks, but it's not Goldilocks yet. We kind of got to wait to Q3. Is that what you're saying?
I think we're just going to have to keep rowing down the river a little bit more. You know, we don't have enough data here for the Fed to make decisions on whether they should cut rates. And what Fed Chair Powell has pointed out at the last Fed press conference, as well as many other times, there is a more accommodative position now than there was a year ago. So interest rates, Fed funds rates are lower now than they were a year ago. And that gives the Fed a bit of breathing room to wait for the data that can help them make a definitive decision as to whether they need to cut rates. But as of right now, there's no imminent need to cut rates. And there's also no reason to expect that they wouldn't cut rates in the future, because inflation does remain modest.
Jason Schenker, thank you very much for your expertise. He's president of Prestige Economics.